Good morning. We're going to go ahead and get started with introductions, just to be mindful of everybody's schedule and get you on your way on an appropriate time. We appreciate you all making your way out here across town in Atlanta traffic to join us. We're grateful hearts for the participation that we've gathered for this program over the years. I think this is going to be a really good program. I think I'm glad to see that the folks who signed up. We've sort of had an overarching theme the last 18 months or so around business transition and the risks associated with that, and we've had a number of different programs that sort of address parts of that. In the past, we've had an ESOP attorney come in and talk about that as one solution for business transition. Chuck's here to talk about sort of one of the other areas of the business that would be helpful to folks that are considering transitioning or selling or recapping or any of those things. He's been an M&A business advisory boutique for the last 18 years or so. He started out in M&A in the industry, working for cable and television, alarm companies, and so got to build his expertise sort of on the buy side of that. And over the years, went out on his own and has been working with dozens of companies over the years and hundreds of millions of dollars of transactions. He's got his bachelor's degree in economics from Georgia State, so warm heart for that as a fellow alum. But he works with clients on selling, buying, expanding, recapitalizing, transition, all those things. And so he's got a host of insights that he's going to share with us, and I think it'll be super valuable. So join me in welcoming Chuck Armstrong. Thank you. If we get anybody online, it works better for them if they do dial in, which we're expecting some too. So.
Okay. Thank you, Doug, for that introduction. Thank you and Katie for coordinating this event. Appreciate all you guys for coming out, and hopefully can share some insight that will be helpful in y'all's business. Basically, just to walk through what we'll be talking about. First, talk about my background and what we do, and then look at business succession, some of the issues. And I'm going to focus on either a sale or recapitalization. Those are items that kind of have been the linchpin of my operation. And then look at specialty contracting. They're unique types of businesses. Each have their own positives and need to be aware of the challenges and the way to formulate a transaction. And then talk about transaction types and process, and then valuation ranges, and then just kind of give a sample of a typical deal and what I call a waterfall of proceeds. And putting together slides for this, actually this is not directly on target, on point, but I thought this was interesting with respect that we are in Atlanta, and half of all construction spending over the next 5 years is projected to occur in 20 metro markets. And clearly Atlanta is one of those, so you guys are sitting in the right place to garner a good bit of business. As far as West Highland, as Doug mentioned, set this company up about 18 years ago. We do M&A, finance, and business development advisory work. I'm the managing member based in Birmingham. My background, over 500 million in transactions, 50 different deals, over 50 different. And prior to especially contracting, background is communications tower deals, electronic alarm, cable television, waste to energy. Those were all a little bit different than specialty contracting in the sense that the commonality there is recurring revenue. And to me, the challenge with specialty contracting is to make the contracting business look as much as possible as if that revenue base is going to be recurring now and going forward. Deals that have worked on or either chasing currently. Closed 2 deals in 19. One was an outside plant, fiber splicing company that does fiber construction in Metro Atlanta. Another was a inventory asset management company. They did cell site, central office, and garage audits for AT&T all over the continental U.S., Alaska, and Hawaii. Have also have got teed up a civil and electrical utility contractor based in Intermountain West. Expect to get that deal out here in the next couple of months. He's about $35 million a year in revenue. Also have a wireless construction company based in the southeast. It's $16.5 million in revenue, and it's currently on the market. Other deals, mechanical contracting company in the Mid-South. I've got a private equity group that's looking for trucking and or logistics company. Billion-dollar general contractor that's looking for solar EPC contractors. So just to give a sense of kind of different types of businesses and industries that have worked around. This gives an idea of perspective or sample transactions. Typically depends on the transaction, but generally the prospect universe is somewhere around 20. More challenging transactions. One, we went out to over 50 different groups. And generally speaking, you kind of put together a teaser, we'll send it out to a broader group. And generally speaking, you might get a handful of folks that are really actively engaged and want to pursue a transaction, and you take it from there. The 2 deals closed in 19 are there. The one currently in process of remarketing. We actually had a non-control investor. We were up to contract on that deal, and my client, upon reflection, decided that he wanted to take more money out of the business. And so we've kind of taken it back to market and are looking for a strategic recap in that business. He's a wireless construction company. Guys climbing towers. We're doing civil work around communications towers. And then the other 2, we got letters of intent, underground contracting company, and civil and electric utility construction. Doug and I were chatting recently, and seemed to be something that a theme here in terms of business succession. And there are 31 million small businesses in the U.S., somewhere north of 3 million construction firms. The expectation is half of those will be looking to monetize or some sort of transition over the next 15 or so years. And within that, 40% or so are considering leaving the business. What are their options? Either sell or some sort of family transition, and either just exit the business or not quite sure. And key to a successful transition is being prepared for a sale and having an idea of realistically what the business is worth before you go to market, so you know what's a reasonable offer and what are reasonable terms. And so having some indication of valuation and a strategy in place is certainly helpful for success. And then when you look at what percent of businesses that go on to market end up selling, the estimates range from 10 to 30% end up getting deals done. In my case, we've either closed or delivered LOIs on every deal represented. In the case of delivered LOIs, there are times when the business owner, for different reasons, in one case, he was just not ready to take the transition and hand the keys to somebody else. He'd been doing it for 20 years, built it up for nothing, and just was not ready. And in the other case, seller had some expectations in terms of valuation that were think, above where the market was. So what we're going to do is focus on sale or recapitalizations, and you got to kind of look out at the market and try and figure out who your prospective buyers or investors will be. A lot of folks look at selling to competitors or some sort of setting up an ESOP as options. What I try and do is kind of put together a comprehensive list of folks that are going to be interested, and there's a range that you go down. Private equity groups, and the key there is certain private equity groups are focused on contracting companies, and they make platform acquisitions, and then they look to add-on acquisitions or investments to aggregate that base. And there also an important thing to look at is the culture of the private equity group. They're not all created the same, and some are better partners than others, so kind of having that perspective. Other prospective buyers include strategics, whether they be public or private operators within your industry, including competitors, and in some cases, general contractors. For example, the solar EPC buy-side opportunity I discussed is a mid-Atlantic general contractor that's looking to buy LED lighting contractors or solar EPC contractors. Other potential folks would be family offices and or search funds. So after looking at who your prospective universe is, we'll kind of take a look at some of the key value drivers with respect to specialty contractors. What I think the primary driver is size and scale. And generally speaking, and again, everything I say here is subject to specific company and to some extent industry, but these are kind of just to give you benchmarks. Generally speaking, 1 to 5 million is kind of the first level of size. 5 to 10 is what many private equity groups would consider what's called a platform deal. It's big enough to have enough scale so that that could be the first deal that they go in and set up as a platform with the intent of growing a business from there. So the good thing there is you're expanding your universe of prospective buyers. And then above 10 million, there again, that expands it that much more, because then larger private equity groups that would not spend the time on a company that's 5 to 10 million, you're opening up the universe to those folks.
Just for clarity, those are EBITDA numbers.
Those are EBITDA numbers. These are to some extent in order, but key here is having a good management team in place, good historical performance data. Typically, the benchmark that guys are looking at when they're looking at valuations is the trailing 12-month EBITDA number, and to some extent that may factor in normalized CapEx, but having a strong management team to support the business owner will certainly help drive value. And this gets back to consistency of profits, which, again, trailing 12 months is the benchmark. Obviously, good to see positive growth trending. On the fiber deal I described, we had a few speed bumps in the road that become part of the challenge for me as the intermediary to help explain that and what the circumstances were that drove that drop in EBITDA historically. And then another positives are your financials reviewed, and then, I mean, if they're audited, that is a total high five. Then,
do your buyers normally require that you get one? if you don't have an audit?
No, but there will be, as part of the due diligence process, you can expect a quality of earnings analysis, which is a little bit like going to your proctologist, but just about that much fun. And there's some, depending upon the deal and the historical financials that the client has, may recommend that you do a QOV up front, but for the most part, my perspective is let the buyer pay for it, assuming that your financials are pretty well straightforward. And then, of course, growth prospects in terms of customers, your industry generally, what do things look like? That's going to drive value. What type of customers do you have? And what kind of customer diversity do you have? The challenge with the telecom asset management company, when I first engaged with him, he was $11 million in revenue and $6 million in real EBITDA. He was the most amazing contracting company I've ever seen. 11 million in revenue and top line and 6 million in real EBITDA with no appreciable. He buys some laptops for his guys in terms of CapEx. That's the good side. The bad side is he only had one customer. So the challenge there became you try and sugarcoat it and find the right color lipstick, but he's serving 3 different divisions within a huge corporation, but at the end of the day, he had one customer. So that was a definite challenge on the value side. How do you get your business? Do you get it via bid? Is it negotiated, kind of steady stream of business? Are you working off a price matrix, or is it maintenance? Maintenance revenue generally is higher value than bid, given the perceived recurring nature of that type of work. And similarly, work where you've got a price matrix, where you're working for like a huge telecom company and you've got a schedule that says, I'm going to do X, Y, Z and get paid $100 every time I do it. That's seen as more consistent than where you got to go out and bid for each job. Now, the caveat to that is what's your bid success rate. So to the extent you can show that, hey, yeah, we do bid work, but 75% of the stuff we bid on, we get, and we still drive a solid margin on it. That's the way you address that. Does your work require bonding? To the extent it requires bonding, then from a financing standpoint, that's going to be a negative for an acquirer, because the bank typically is going to take that amount of work out because you're not going to be able to leverage the work that's bonded. Commitment of the management team as the owner. Are you good with staying on for some transition period, or are you looking to throw somebody the keys? If so, do you have a solid management team in place to support you that has day-to-day interaction with your customers so that you can make a reasonable argument that, hey, I'm just here to read the Wall Street Journal and these guys run it day-to-day. And so that's going to be key as to whether or not, to what extent the owners anticipate to stay actively involved. Safety history is key. Whatever your mod or EMR rate is, to the extent it's less than 1, good. When it goes north of 1, then certainly to the extent you get farther north, it becomes more challenging, because your ability to capture work in the future is going to be adversely impacted. And do you have any outstanding or pending litigation that's going to impact you? Self-performance, what percent of the work do you self-perform? With respect to your subcontractors, do you have legal documentation with all of them, arm's length contracts, that sort of thing? Everything's in good order. If you've got guys going out doing the same thing every day that are subcontractors, if it's critical that you have good contracts in place with them. What are the end markets that you serve? Are there certain barriers to entry, whether it be licensing, specialty equipment, and what are your company's competitive advantages? How do you get work rather than it being awarded to someone else? And in terms of markets that would go to with respect to, yeah, sure, go ahead. Honestly, not so much. I mean, it depends on the industry. Most contracting guys are not that sophisticated that they've got in multiple offices where you've got that sort of thing, but not to say that that won't become more of an issue. So in terms of once you kind of get everything together and figure out what the business is and what its advantages and challenges are, then you look to identify, or I look to identify initially a targeted group, typically of folks that are in the industry or in complementary parts of the industry that would be interested in doing a transaction. And then also look to extend the reach via an investor platform that is a group of folks that are interested in basically present a teaser to them, and it's 125 plus different, whether it be corporate, private equity, search funds, family offices, and they look at all kinds of deals and provide them with a teaser and then get some feedback, and there again, the intent there is to kind of broaden the universe and look for folks that may have interest as well. And with respect to transaction types, talk about 3 different types of transactions. First is a straight buyout, and key here, again, is going to be if, as an owner, you have a real solid management team in place that deals with the day-to-day and all the customers and that sort of thing. In that circumstance, it's possible to structure that sort of deal and expect that there'll be 3 to 5 year non-competes and some sort of consulting services agreement. And there, the negotiation becomes, if you really want to walk away, how much active participation you need to have in the business going forward. My expectation with respect to especially contracting groups, most deals are going to take some form of a strategic recapitalization. In that type of deal structure, you and the investor / buyer agree to a valuation. Let's say it's $10 million for your business. And as part of the deal, you're going to harvest, let's say, $6 to $8 million in cash at closing. And you're going to take that other $2 million as equity that you'll roll into typically a larger transaction, which is comprised of other similar type contractors. And the expectation is over time, the aggregate, first of all, has more value than each of the smaller companies. And so you'll benefit from the organic growth of the collective companies and then also the scale associated with the aggregated business. There again, would expect, regardless, you'll be asked to sign some sort of non-compete for typically 3 to 5 years in that as well. There are also groups, and this is a smaller group, realistically somewhere 5 to 10 potentially, that are more private equity folks, potentially you may be able to find family offices that would fall into this category, but that would do non-control investments. And when I say non-control, that would mean they're not going to own over 50% of the equity. Now, if you're a guy that's been operating your own business, when I say non-control in this circumstance, that will not be descriptive because there'll probably be a lot of things that feel a lot like control, even though they don't have control equity. And in this type deal, key management and the expectation most likely his owner would stay on and manage and grow the business. And there are groups out there that these are structured all different types of ways, but I would expect some sort of redemption right for the investor at some point in the future, say 5 years out, that they would be able to harvest their investment back and some sort of dividend that would go along with their investment. In terms of a process, first off, we collect preliminary documentation. We'll execute a mutual non-disclosure, a listing agreement, and then collect due diligence materials for a confidential information memorandum. And this is the information collected at this stage in the process is intended to be stuff generally off QuickBooks or your accounting software and other information that's generally readily available out of your files and that sort of thing. It doesn't get to a investor's or buyer's due diligence level. And then put together descriptive materials. There'll be a teaser as part of that, which is kind of a one-pager that basically gives somebody enough information to be familiar with the business but not be able to pinpoint it on a map and know what business it is specifically, but to give them enough information that they are interested in learning more, at which point they would execute a non-disclosure agreement to get the full descriptive memorandum and associated, typically, financials that go along with it. And like I talked about before, generally speaking, I would let the buyer do the quality of earnings, but depending upon the circumstance with the company, it may be advisable to do a quality of earnings up front, but that would be on a case-by-case basis. Then get out and market the opportunity to the financial investors and strategics, look to extend the reach, and then look for folks to provide indications of interest and or letters of intent, and ideally have multiple offers. It's not always going to be the case, but certainly that is the objective. To the extent you can have multiple horses on the track, everybody's going to run a harder race to get there.
Just to go a little below the surface on the quality of earnings, I mean, you said it was kind of like an audit, which I agree, but it can also be good for the seller, because if a business owner's running personal expenses through his P&L and doing things that a buyer is going to see those as sort of atypical, they're going to pull those out, and actually, it would improve your pro forma EBITDA analysis.
And those are things that I look for in sitting down with the business owner and kind of walking through, what's your gas bill for your G7 and that kind of thing. But, yeah, certainly look to take those expenses that might be of a personal nature that an investor going forward would not be expected to assume. And even cases where if it's a $20 million deal and you've been taking out $500,000 a year in salary, you may go, you know what, I can do with $200,000 or whatever. You may make adjustments based on what your expectation would be going forward that would result in further adjustments to that.
We just learned about an agency in our business that's recently sold to a private equity group, and they were running an 8% EBITDA bottom line, and they pro forma'd it up to 27% to sell it, which is crazy if you ask me. But
well, you have 2 or 3 pages of notes after the financials that all go back to the descriptive. But,
it's exciting to us because we figure they're going to be firing a bunch of people, and we'll be able to hire some good people.
Once you get a LOI in place, and the objective with an LOI or letter of intent, from my perspective, is to have it as detailed as possible, not to have it kind of a one-pager, kind of broad brush, but really to try and drill into what's the multiple, what's the anticipated EBITDA delivered at close, what are any adjustments to that, are there special add-ons that will be included, how long for due diligence, when is closing, and that sort of thing. So look to get as much detail in the LOI as possible so that everybody, it's used as a template for a contract going forward is the objective. And then once you have an LOI in place, put together a virtual data room in which folks from the investor, whether it be their internal folks or accountants or attorneys, documents will be delivered to the virtual data room. Everyone can access it. They'll come in and do detailed due diligence, which they're again, they'll bring in accounting folks to do a quality of earnings study. They will, depending upon the size of the deal, bring in HR people to look at all your HR policies and that sort of thing. Obviously, the legal folks and all that good stuff. Simultaneous with that, as you kind of get a little farther along and the investor kind of has a sense of what any issues might be, you'll get a draft contract, go through, negotiate points on the contract, and look to close. In terms of a timeline, according to the Business Brokers Association, the average is 8 months. Preparation, this is just my personal, preparation is 1 month plus or minus, and that's totally driven by the owner in most cases, to the extent that the owner is providing documents as requested, then the descriptive materials can be put together quicker and get out on the street. And the challenge in my circumstances, oftentimes guys are out, they're out in the field, they're running their business, and it just takes a little bit additional focus either for them directly or for some of their administrative folks to pull together the info on a timely basis. Marketing timeline is actually it's totally variable. So much depends on the size of the deal. Smaller deals are tougher to do. You're looking for a specific buyer that's got a specific need to fill, and you gotta find them at the right time. Larger deals, $5 million plus in EBITDA, are going to be, in terms of finding that interest level, quicker to get done. They may take a little bit longer in terms of due diligence. So, again, on average, 8 months would be, generally speaking, something to anticipate. What's a company worth? Businesses trade at wide range of multiples. This is from Business Valuation Resources, third quarter of 19, and construction businesses were running at 3.9 times EBITDA. And if somebody's buying on the basis of EBITDA without an adjustment for normalized CapEx, effectively they're understating what the real multiple is with respect to free cash flow. Because generally, most construction businesses, you got a fairly substantial CapEx spend on an annual basis, whether it be to accommodate new projects or replace the equipment you have in the field. So just as an example, at an underground contractor with an offer at 4 times EBITDA, he was about $1.5 million in EBITDA on $6 million in revenue. He was spending $600,000 or thereabouts or better in annual capex. His effective free cash flow multiple was 6.7 times. Similarly, a civil and electric contractor at an offered 4.6 times. When you factored in capex that he was spending for graders, track hose, all sorts of different equipment, it bumped the free cash flow multiple north of 5.6 times.
And that increases the value of the business?
I'm doing this as a broker to help sell to the seller, to hopefully that the seller understands that so many times a guy will look at it and go, well, it's only 4 times because it's a multiple of EBITDA. Well, but look at what you're also investing that's not included in, it's reflected on the balance sheet. It's not reflected on your income statement, that you have to factor in to really get to. I mean, fundamentally, it's about how many years would it take for me to replicate this revenue? And then that's before the tax impact, which if you're selling something and getting some portion of it treated at cap gains, that's going to bump up that effective multiple that much more. To me, that's just a way of looking at it that more accurately reflects how long would it take you to replicate that amount of income. And then you got to figure in the contracting business, what's the risk associated with over that timeline, I'm going to be able to steady state and make that happen. Does that make sense?
What's CapEx?
Capital expenditures, like I say, I mean, horizontal directional drills in the underground construction business, track hose and civil utility, fiber splicing gear, and fiber business. Generally things that are on the balance sheet and depreciable items as opposed to things that are expense. And this just, again, from BVR, provides kind of a running average of collective multiples. And the point on this one is the multiple line isn't static. It changes over time. And getting to when you potentially get involved in a deal where you're doing a strategic recap for a private or with a private equity group, part of the rationale is that there's a premium for larger transactions. That's why they're aggregating a bunch of smaller guys, because just on the face of it, there's a premium. And this just shows the spread between public buyers' multiples and private sellers, and also to the extent public companies that do the same thing that you do, and generally speaking, they'll be doing a lot more things, a lot different types of things because they're so much larger, but they can provide kind of a benchmark of where the market's going in terms of valuations. In terms of valuation ranges, we just talked about a little bit. They're often trades for multiples of adjusted EBITDA, and to Doug's point, adjusted means anything that can add back that an investor would not be reasonably assumed to be incurring going forward. You would look to add back to your EBITDA, and again, that's going to have to survive a quality of earnings analysis. So you got to be able to document it, but the objective is to enhance your EBITDA as much as reasonably possible. And like we talked about, the effective multiple of free cash flow after CapEx can be a lot higher than when you just look at the multiple of EBITDA. If you spend a lot more regularly on an annual basis to replenish your capital equipment, then you can expect there'll be a relative adjustment with respect to EBITDA multiple because the buyer is going to have to make that same investment to maintain the equipment to do the work. I mentioned briefly, but generally speaking, at least some portion of a deal will be subject to cap gains versus ordinary income rates. So you'll derive some benefit of cash by virtue of doing a transaction in this sort of structure, as opposed to if you just operated the business for another 5 years, you could expect to pay higher tax rates. And I mentioned a little bit before, special circumstances, the guy with 11 million and 6 million in adjusted EBITDA, he traded at less than 3 times because he had one customer. In retrospect, had he gone out and he was doing 55+% operating margins, and so his attitude was kind of, if I can't do 55% operating margins, why am I going to do business? It's not worth the hassle. If he'd got another couple, 3 customers and had 25% margins, or hell, did it at break even, that probably would have been a 4 multiple. So diversity of customer base is huge, and to the extent you're more concentrated, that's going to become more of a challenge. And then the seller with the fiber guy with less than $1 million in EBITDA, he was able to command 4 times, and we were able to get other credits for CapEx he had spent in the 6 months before closing and some other benefits because the buyer, it was a great strategic fit for them. It was a service. They already had an office in the market, but they tried to do what he did, but they did it very poorly. And so he was a great add-on for them. So that was one of those deals where it was a great circumstance and ended up working out well on both sides. In terms of looking at consideration for sellers' pre-tax proceeds, typically deals you're going to be required to retire or pay off your long-term debt. Generally speaking, the deals are structured such that the anticipation is, from an investor standpoint, that the objective is working capital will be enough in the bucket at closing so they don't have to come off the hip and spend another $1 million to fund working capital at closing. The investor's objective is to have a big enough working capital bucket at closing so they invest in the business, it kind of keeps operating. You got additional opportunities to grow the business, they're happy to invest in that, but they don't want to have to come off hip just to fund working capital. So that becomes, part of the negotiation is how do you calculate that working capital? My guy with the wireless construction business, he did $2 million his first year, $3 million the second, $7.5 million the third. This past year he'll do $16.5 million. So he's growing pretty rapidly. So his accounts receivable has been growing rapidly, and so the working capital time frame is pulled in because the investor is looking at, I want to make sure I have enough to cover that growth in the business. Somebody that's on a more kind of flat plane, solid growth, but not that kind of year-to-year increase, typically would look at doing an average of 12 months in terms of your working capital. And working capital in this circumstance is going to be defined typically as accounts receivable less accounts payable, and it's net of cash. So cash is kind of a separate bucket. And how much cash does the investor require that you keep on the balance sheet? Some companies may keep a ton of cash on the balance sheet just so they have it covered in the case that you have a downturn. The objective here is that you're going to free up most of that cash and you take it off the table at closing, and it becomes the investor's obligation to fund the business going forward. So that's another kind of point of negotiation and analysis as you go forward. And then if it's a strategic recap or a non-control equity investment, there'll be rollover equity, which would be the amount that you're going to put back into the larger deal. And what are the terms of that? How much of the larger deal do you get? Those will be items to consider. And then typically there'll be an escrow amount, anywhere from 5 to 10% of the purchase price. And that's typically out there for making sure that there aren't breaches of reps and warranties. If you had diesel storage tanks that you had stored atomic fuel in or something. Anyway, there was not a breach of rep and warranty, and typically the timeline on those is somewhere 12 to 18 months once you get through there, and typically there's not going to be an issue on that. That'll be released. And as I referenced earlier, just to kind of get an idea within your industry, if there are public companies that are benchmarks, they're a good kind of indicator of which way the market's going in terms of private company valuations, keeping in mind that if a public company's value is 10 times EBITDA, you're going to be traded at a discount because you're way smaller than they are, and larger companies typically trade at a premium, depending upon their growth profile. And in terms of specialty contractor multiples, again, this is subject to, depends on the industry and what services you're providing, but just to kind of give you a range, 1 to 5 million in it, trailing 12 months EBITDA, 3 to 4 times, 5 to 10, 5 to 6, and then there's step-ups from there. And this page kind of gives an example of a strategic recap and the proceeds waterfall, which in this circumstance, the company was doing about $1.9 million in trailing 12 months EBITDA at a 4 multiple. They had $600,000 in debt, so their net equity value was $7 million. So $7 million, and then they had the 6-month average balance sheet. They were going to end up, they would be able to net, they were required to leave $760,000 on the balance sheet, and then the balance of cash and accounts receivable above that, they got credited at closing, which was $1.3 million. So they were going to gross proceeds of $8.4 million, roll 20% of the purchase price into the new deal, and then 10% in escrow. So net cash at close was 6.1. Negotiated a little bit of a spiff, depending upon growth that they hit within a predefined period after closing, and then return of escrow was contingent in escrow payments. And here at the bottom kind of gives an overview of how the proceeds were paid out. So effectively $6.1 million at close, and then over the next couple of years, did I just turn it off? Okay. I was getting all excited with the pointer thing. And the total with the rollover equity, if you assume 30% IRR over 2 years, is $10 million at a secondary liquidity event, at which point the expectation would be at some point in the future that private equity group is going to monetize the deal again, and that's where you'll get the second bite at the apple. that kind of lays it out. Certainly love to have any questions or anything I can.
What do you recommend, as kind of first steps? Somebody's looking at trying to, figure out a transition, whether it be internal, external, whatever. I mean, do you encourage people to, get a valuation as a part of that thought process if they're not already doing that?
I think it's a good starting point, and depending upon how much detail looking at for evaluation and what it's going to be used for, whether it's just for internal purposes or for some outside purpose, I think certainly a worthwhile investment.
We get it done here because we trade stock, among a shareholder group, and so we get one every year. We find it to be extremely useful just in terms of, I think you made the point somewhere along the way, is that we don't intend to sell it, but we run it like we, have that intention. So we run it at measuring ourselves against top tier metrics and, measure our reinvestment back into the business and, the bottom line, just a whole host of key performance indicators that we hold ourselves accountable to that are sort of illustrated in the valuation and spoken to.
And I've had a client who's got a great business, and he's more of a field guy. He'd rather be out in the field than dealing with the day-to-day. And again, he's got a great business, and it's very profitable, but that's not something that he's focused on just because that's not necessarily his thing. But I think when you're operating a company on a basis like this, it's helpful to have somebody periodically come in and see where you're going.
Even if you're selling to somebody internally, a partner, sure. You want that.
Well, you have
to be reasonable and fair, and it'll tethered to reality and the performance of the business.
On an internal deal like that, if you try and stretch it too much and create unrealistic expectations from the buyer, and you take back seller paper, this may be good for you, you may be happy with it, but you may end up sitting back in the seat and running the business. But my expectation would be when you come back, it won't be running as well as it was before you left, or else you wouldn't be coming back. So, you have to create realistic expectations both with an internal sale and external, because at some point, there's a continuum of valuations and similar companies out in the market at any one time. And somebody else may do a deal at a half turn lower than you are and get the deal done. If you're holding out for that extra half or full multiple because you think yours is special, and there may be special things about the business, but at the end of the day, it's where somebody that's going to write the check writes the check. I had, again, a client that we went through evaluation, we went through a marketing process, a number of different offers on the table, and came in right around 4 times, and his accountant told him, well, it's worth 8 to 10 times. My question was, is your accountant writing the check? Because at the end of the day, fundamentally, it's about a qualified buyer that can execute. And so
it's significantly a function of the buyer being able to finance it in a reasonable fashion, right?
Yeah.
And 8 to 10 is not going to be, presumably in that case, would not be reasonable. Somebody's not going to go out and do that. On the fundamentals of the business, the returns that are coming out of it.
I would have loved to find that person, but I wasn't able to identify him. But
I guess the cost of evaluation varies depending upon the business, but it seems if you do them repetitively or on an annual basis, that cost probably comes down.
It's pretty reasonable for us. You're right. Because I think the first one's the hardest one. Right after that, they're kind of recranking the machine every year, and they're looking at market indicators too. So it's not like it's just a crank, but it is a lot easier to second go around, third go around.
And to some extent, a factor there is going to be how specialized your service is within that market to be able to find other comparable transactions. So that's going to factor in because they're typically you're looking at comparable transactions and then some kind of valuation based on a discounted cash flow. And those are kind of the two things typically you're going to look at.
And in our case, our provider does a lot of transactions in our space. They have a really robust, data set that they're able to compare to.
I would imagine for a business like yours, you all have to have licenses, and that's valuable too.
Yeah, I mean, that's kind of a neutral. I mean, you have to have it to be in our business.
Oh, any buyer is going to have that anyway.
Correct.
Gotcha.
It's not really driving anything up or down.
For example, you got a 20% recapitalization for the owner. Is that, when he wants to take that off the table, is that set up deal and then how soon he can get out?
Typically, you're hitching your wagon to the investor, and that's going to be determined at some point in the future, 2 to 5 years out, when the investor wants to monetize their investment in that space, typically. And that can range, the 20% could be 10 to 40% or 49%. I mean, if you feel real good about the business, your primary intent is to diversify your personal net worth, you may want to roll more into the bigger deal if you really like the bigger deal. So that's all part of the negotiation. But it's not typically up to the seller's not typically able to pull the trigger on 2 years out. Hey, I want my money out. You're along for the ride, which is why it's important to make sure you got a partner that you can work with.
So I have no ownership or that I've worked with. If I were wanting to be a buyer, or wanting to approach the owner, what would you recommend from a financing standpoint? If we can understand what the value of the business is, how to evaluate the business, but how would I, without any current financial backing, become an owner and make a cash offer at something?
Presumably you've got a good relationship with the owner.
I do.
And first thing would be, would the owner take some portion of the proceeds as seller paper? And because that's going to be the best debt that you're going to be able to get, depending upon the size of the deal. Assuming smaller deals is going to be harder to find debt for construction companies, period. So to the extent the owner will finance some portion of it, then that becomes key to getting the deal done. Larger private equity groups that have 15 million in EBITDA, multiples somewhere 2 to 2.5 times debt, but that's a much larger, typically, entity. It's been my experience in trying to find standard commercial lenders that will lend on a construction business that's doing $1 million in cash flow is much more challenging. You can get accounts receivable finance. Certainly the first step is factoring, which you don't want to do. But accounts receivable finance, an asset-based line can be a great opportunity, but there are limits to that's kind of tied to your accounts receivable, and most likely will not get you to where the full valuation is. And then what are the value of the assets, the physical assets, as depreciated? The bank will lend against that again on an asset-based line. And an asset-based line, you can get anywhere 5 plus or minus % interest. But again, it's going to be somewhere 60 to 80% of your AR. Half of your physical assets will be kind of the limit of what somebody will loan on that, depending upon your personal balance sheet.
Are you talking about a minority position or a buyout, a majority position?
Well, I don't know that a majority would be.
I was just clarifying because.
Yeah, I don't know. I mean, that's ultimately you got to start somewhere.
Right.
Our owner is one of those earlier stats that you were talking about. It's probably going to be done in about 5 years, and I would much rather be the guy to take it over. But he's not going to give it to me. He's going to look to sell it. So he could sell. He could go through one of the various options. But as a buyer, someone who's interested in buying, how would I get the resources to put myself in a good position, put the company in a good position over the next 4 or 5 years to make that happen?
Have to understand more about the business. I can throw you a card right here. But again, the seller financing would be the first option that certainly to the extent if he were receptive to that would be typically the best way to get it financed.
Sounds like you need to probably up the past couple funding for his earnings.
But
and say if somebody else wants to say, I just think you say.
well, but you're not talking about earnings, EBITDA, and there again, let's not forget about capex, and it also depends on how big your EBITDA is. Again, there are the stair steps and.
I want to be on a technical, even though you know, the capital intensive company, most of it's not. Those equals, that's number one. Number two is we're talking about a company that is, I think, one of those contract, Sarah, 16 or something. So, that rate, you're receiving it, right? Something like that. You're 10% of the bottom line.
Their turn was better than that on the receivables, but I agree with you with respect to the EBITDA being a flawed valuation construct. But I mean, typically folks look at, you're looking for a quick benchmark, and the EBITDA multiple may be adjusted downward to somewhat reflect capital-intensive businesses. So,
And if you want to acquire other firms, again, the financing's the same way. It's just whatever way you can do it.
yeah.
It's just, there's all the options on the table.
Quick fix to the taxes, insurance, taxes.
Right.
I agree.
Good stuff. Well, we appreciate everybody. Appreciate you doing this, Chuck.
Well, thank you. Thank you all for coming out.
Please be on the lookout. We've got another program on a breakfast program this time on February 5th. We've got a friend of mine coming out who is going to talk to us about opportunity zones. That was part of the tax bill that went through last year. Atlanta's got some pretty significant opportunity zones where either personally or corporately you might have an interest in learning more about that, because there's some potential booming opportunity zones, particularly in this area on the west side of Atlanta as an example. So if you're interested in that at all, look for that invitation. It's February 5th breakfast. Thank you.
Thanks, Tim.
I heard you came down to under the weather. Jay? Oh, yeah, Jay. That's all my blue or gold, or they say it's a virus.
Now, I don't know.
It's okay. It's a big deal. I said